Hey guys, Whitney here. Welcome to the Passive Investing Made Simple class. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com, and I'm excited you've joined me today. For our webinar, we are going to be focusing on the best real estate strategies for a high interest rate market. We are going to get into some market dynamics as well, so that'll be interesting for us to explore. But most importantly, you're in the right place if you want to learn how to turn your active income and savings into passive income and long-term wealth. Maybe you've tried to invest passively before, but just never could get comfortable with making the investment. Or you've actually invested in a deal before and went, oops, I did a ready, fire, aim situation and I might have made a mistake. Or you're just simply, here to sharpen your skills. If that's you, you're in the right place. Now, before we dive into today's topic, I want you, if we've never met before, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. But I'm not just another talking head trying to teach you about passive real estate. I've actually done the active side of real estate before, as well as scaled a passive portfolio at the same time. Now, my journey starts off in 2002 as an accidental landlord. And, over the next 15 years, I scaled a single family rental portfolio, did over 5 million in fix and flips, bought the multifamily building, then went into general partnership with two other partners and scaled a private equity firm. And so that was the early part of my journey. And then realized that I did really well at building up equity and cash flow, but I couldn't really keep my money working as hard as it possibly could. And that's when I stumbled across passive investments. And what you see here on the screen, the 800 million in active real estate, does not include my passive investments that I've been able to scale too. Now, I document my entire journey in my book, Money for Tomorrow, that I published with Bigger Pockets. So if you want to know more about me, how I was able to scale a portfolio that gives me 100% financial freedom, if you want to learn the actual blueprint that I am teaching my daughter on how to scale wealth, check out the book, Money for Tomorrow, How to Build and Protect Generational Wealth. But again, at the end of the day, you are not here. You're probably a high income earner. Maybe you're a business owner. You're not here to figure out how to go buy your own single family building or a multifamily building. You're not here to actively scale a portfolio. Why? It's because you have a higher and better use of your time. You're able to earn the income from your day job, from your business. And that is what we want to do. We want to take that income, that active income, and transition it over into passive income and wealth. Now, this takes time. There are periods in the market where somebody can scale a passive portfolio lightning quick overnight, but I argue that you actually want to start investing in assets over a longer period of time. But really what you're trying to do at the end of the day is repeat a result that I have in my life, which is 100% control and choice on how you spend your time. And that is like true freedom. And we can actually help you scale a portfolio like that here at PassiveInvesting.com. We have our multifamily, self-storage, express car wash assets. Right now in this market, it is our debt assets that are providing our investors with an immense amount of cash flow and liquidity and flexibility. But we can help you do that here. Now, if you haven't joined our passive investing club, I encourage you to scan the QR code on the screen or go to passiveinvestingwithwhitney.com. There you're going to see or get priority access to our open deals. You'll have the opportunity to schedule a one-on-one call with me, and I can help you go through your investing goals and help you make sense of this market, what could help you achieve those goals. And then more importantly, you get plugged into educational resources like this on a regular basis. Now, today we're going to be talking about how can we invest in a high interest rate environment. This is not financial advice, legal advice, tax advice. It's educational purposes only. If we get into anything that could be construed like that, please take that back to your investment team before making any investment decisions. Now, you've heard me, if you're a regular to the show, you've probably heard me a lot in the past few months say 2025, we have to take a very strategic approach, right? If 2023 and 2024 were really kind of like hanging on to the side of the pool, waiting for all the waves and the volatility in the market to settle down. What makes 2025 really any different? Okay. Well, 2025, we had the change in the United States and a change of administration, but everybody thought in 2025, everybody, especially in commercial real estate, thought it's survived to 2025. In 2025, we're gonna, maybe have a change of an administration. We're gonna, see interest rates start dropping because the Fed's just gonna have to do that miraculously for some reason. Now, what we have here is kind of another perfect storm brewing. Okay, we have a ton of recession signals that are like flashing bright red. They've been flashing red for a while. They're actually just flashing more vibrantly. Okay, again, we already talked about the consumer confidence index had dropped to, huge lows in March, and it's dropped another 12.5 points in April. We've got our expectations index that has tumbled yet again. Okay, it was at a 12-year low in March, and it's beat that again in April. We're still seeing private credit defaults. Okay, they're still hovering the same from March to April. That number remained unchanged at 5.7%. But what we are seeing an uptick in is the health care defaults. So more people are not paying their health care bills. Okay, inflation rose 2.4% in April. Okay, so that is, if the Fed has its dual mandate, meaning that they're trying to hold inflation between 2 and 3%. Okay, they're kind of right on target. But why are our consumer pricing up 23%, right? Everybody's feeling the pinch at the grocery store. All right. And then unemployment still hovers around 4.2. It saw a 10th increase in April. We do expect that number to make a pretty drastic jump here in March and April. And then we have that inverted yield curve. With all of this happening, why have the Fed not lowered interest rates? Why are interest rates not falling? Now, if you're new to passive investing, maybe you're sitting on the sideline. Maybe you're just nervous because you see all this and you're sitting on the sideline. Maybe you've been burned before and you're just like, I'm going to, wait until some of this volatility works itself out in the market. But here's the thing, sitting on the sideline, okay, can also have consequences too. Now, why are interest rates still high? That's kind of, I think what's on everybody's mind. Okay, if the Fed is supposed to be creating the soft landing for us with the economy, they also have this dual mandate where they are to hold inflation between 2 and 3%. Why is the Fed just still holding on and not really dropping the interest rates? Well, it's because interest rate, the Fed does one thing, but real estate interest rates are actually not tied to the federal funds rate. And I don't think a lot of people, real estate investors, whether active or passive investors, really truly understand that. Real estate interest rates are actually tied to the 10-year Treasury. Now, 10-year Treasury Fed funds rate can have some loose correlations there, but really, the 10-year Treasury is remaining high for two key reasons. One, there's a lot of economic uncertainty, which we presented on the slide before. And if they start dropping interest rates, I think the Fed is, worried about stoking inflation again. And the 10-year Treasury is looking at that. The 10-year Treasury is also looking at that we have probably some mass government layoffs coming here in the next 2 to 4 weeks, and that we also have the implementation of tariffs coming, both of which are going to hit economic uncertainty and cause more inflation. All right, so when the Fed fund drops rates quickly, it actually, I know everybody's crossing their fingers and they're hoping for it. That actually means the market's not doing well at all. Okay, so that means nothing good is really happening in the market. So we kind of have this double-edged whammy here. All right, if we need interest rates to fall in order to be able to buy real estate, get into equity deals, but if they're staying high, how do we as investors as limited partner investors, make sense of what's going on in the market, but also invest to get ahead, to keep our money earning better than inflation, and also produce a return for ourselves until such time we see this drop in interest rates, mortgage interest rates, and we start seeing more equity deals. Well, let's figure out how to do this. Okay, so again, how do we invest and win in what we are projecting is actually going to be an economic downturn? All right, so over the past few weeks, we've been really hammering, laying out step by step on how you can get clear, how you can get liquid, how you can start building your all-weather passive portfolio. I would be remiss if I didn't do a teeny little recap of those two steps before we dive into deployment of capital. But step number one, okay, for you to be a formidable investor, really confident in your decisions, you have to make sure that you're clear and liquid. Okay, so you have to understand your income and expenses. You have to understand how much in reserves that you need to keep liquid on the sidelines, save capital. Okay, and then you've got to understand what are all your other investments and are they optimized? Okay, do you have lazy money sitting around, such as in a home equity line of credit, cash and savings, or overfunded brokerage accounts? Okay, I outline this step in the first two sections of my book, Money for Tomorrow. Okay, this will help you get your financial house in order so you can move through step number two and then into step number three with confidence. Now, last week, we really tackled step number two. How do we deploy or build a smart investing strategy? All right. We looked at it through the lens of diversification. We also looked at it through the lens of building a fortress balance sheet. Okay. Either way, whatever lens you look through, step number two is meant to help you create a portfolio that's going to perform whether the market goes up, down, or sideways. Okay, it doesn't mean that your portfolio, 100% of your portfolio is performing 100% of your time. It means no matter what the market cycle is, whether the markets are hot, whether the markets are cool like they are right now, or where they're volatile and things are getting really messy, that a chunk of your portfolio is going to continue to produce for you. Okay, so again, when the markets are hot, equities are going to shine. When the markets are cool, debt investments are going to shine. But more importantly, we want to make sure that our portfolio is structured as such to give us that flexibility to tap into no matter what market we happen to be in. And that really is akin to the market cycle. We've been talking about this a lot too. We need to have investments in our portfolio that perform not just when the markets are expanding, okay, not when just when the markets are recovering, but we also need, assets in our portfolio that are going to perform when our equity investments are challenged, okay, when the markets are in a hypersupply or a recessionary environment. They also need to perform whenever the credit gets sucked out of the market cycle and banks stop lending. Okay, we need assets in our portfolio to help us ride out this volatility in the markets. And more importantly, we need to have assets that take advantage of the macroeconomics that we are seeing in the market. And I think a lot of people are sitting here kind of torn, right? The past 2 years, a lot of limited partner investors have kind of exited the passive investing space. They were like, real estate, no way am I touching that with a 10-foot pole. Like, look what happened. Interest rates, became volatile. My whole portfolio had an issue. Well, that's because we had not good diversification in our portfolio, okay? But it doesn't mean that real estate still isn't a good bet, because if you flew from real estate and went into the stock market, we all know what happened in April of 2025. You experienced another probably downturn of another 15 to 20% of your portfolio there. Now, real estate just moves slower, okay? And it's still propped up by some good macroeconomics. And that is housing still required. People still need a roof over the head. For me right now, if you guys are watching the video with me live here today, it's pretty dark where I'm recording because it's raining outside. I have to have a shelter. I have to have a roof over my head. The US market is still undersupplied, somewhere between 5 to 10 million homes. Now, here's the thing. Some markets are overbuilt, other markets are underbuilt. All right. So, but the overall, from a national level, there's still a lot of homes and units to be delivered. The key thing here is to understand two things. One, where do units need to be delivered? And two, that we still have a nice runway to tap into real estate before we hit the next part of the cycle. And that is units would have to, construction has pretty much ground to a halt. If construction restarted today at full force of what it was in 2022 and 2023, it would have taken, at that point in time, taken 4 to 5 years to close the housing gap. Okay, I would say we're closer to 7 to 10 years to close that housing gap now. All right, so, but keep in mind, again, real estate is still very local. Okay, so we did a quick recap on getting clear, getting liquid, okay? We did a quick recap of why we need to diversify into what I call an all-weather passive real estate portfolio, borrowing some words from Ray Dalio in his book, Principles. Now, let's talk about the deployment of capital. That's really step 3, okay? And that is, we need to understand what we need our capital to do. Now, a lot of investors that I talk to, they're like, I need out of my day job like tomorrow, okay? Well, we do have to, build parts of our portfolio to provide us what we need today, but also look to the future of what we need our portfolio to do. And really, I encourage people to think of it like, what do you need? Cash flow, equity, diversification. Take a look at your timeline horizon. If you're in the accumulation part of your portfolio, you might be looking for more equity deals or an equity-like return. If you're, say, somewhere, 10 to 12 years before retirement, you may be starting to take some of the equity pieces off the table and transition it more into cash flowing assets. Okay, so you're looking more for assets that are going to give you flexibility and liquidity. And then if you're approaching retirement, you may need a substantial part of your portfolio to provide cash flow for you to stabilize that ride because you don't have your income coming in from either your job or from a business. All right, so step number 3, or step number 3 of step number 3, I should say, is what is your appetite for risk? Okay, now the key thing here is two key things. One, we want to create alignment, right? If you're somebody that is like, I can't sleep well at night, if there's any risk associated with the investment, then we need to look for things that are aligned with that type of return. Meaning, we can't expect to get a 20% internal rate of return with an asset because that's probably pretty risky. We have to take on some risk to get it if we can't stomach the risk. Now, the point number 2 is, when we look at appetite for risk, make sure we invest in assets that aren't going to knock us out of the game. Okay, if we borrow from Warren Buffett's rule number 1 of investing, it is don't lose money. Rule number 2 is rule number 1. Okay, even if you go into an asset and you, I'll speak for myself. I've invested in an asset recently that I just got my original capital back and maybe like a couple $1,000 return on top of it. Not very powerful return, but here's the thing. I lived to see another day. I now have that capital back in my hand and I can redeploy it. Whereas I could have gone into a much riskier ground up asset. I've seen some of these happen lately where capital is 100% lost, right? So we need to understand the risk for appetite, and it's more important that we don't get knocked out of the game with trying to take on some crazy risk that we probably shouldn't be doing so to begin with. Then step number 4 is look at what the market's giving you, okay? Are there equity deals out there? Sure. Are they good? I don't know. May not be the time to invest in them, but the market is giving us debt. And we should take a look at that. This is the perfect time to inject this type of layer into our portfolio. Now, I want to pull forward this concept and expand on it that we tapped into last week, which was diversifying into an all-weather passive portfolio. And that is, we're essentially building a house. In the case of this house, it's the capital stack. It looks like a pyramid. Now, the foundation of this house is going to be our reserves and liquidity, right? That 6 months, maybe upwards to 12 months worth of reserves and liquidity, that helps us, kind of like a warm blanket at night, should there be like a job loss or some sort of like interruption in income in our active income earnings. And then the ground floor, okay, the first layer of the capital stack is we should inject into our portfolio, especially right now in this phase of the market, low risk, liquid income plays. Okay, this is where our PIC debt income fund, or excuse me, PIC debt fund one, that's in first lien fix and flip real estate, that becomes a really nice cash flow layer to inject here. Now, I was just recently at a conference this last weekend, and we had a conversation around debt amongst many of the investors. And I had one investor that says, yeah, I invest in a fund that pays me 3.5% a month. And I'm like, wow, that's like almost a 40% return. I was like, and he was like, it is first position lien. It is the so safe. And I'm like, tell me more. You could see the terror on my face. He goes, it's in ground up entitlement and construction. I was like, that is probably the riskiest asset that we could be investing potentially in. Okay, there's a lot of unknowns with entitlement. And that is where you're getting all of your permits to actually build a building. You're getting your construction and design. You're actually, getting the permits to have water and utilities to come to a property. Okay, and you haven't even built the property itself. Okay, so I'm talking about here in the senior debt layer, again, really low risk opportunities in, say, fix and flip real estate. The only thing probably safer than that would be holding somebody's primary mortgage on their property, mortgage-backed securities. So that gives us our ground floor. How can we get cash flow and liquidity there? Okay, then we're going to build our second floor. Again, the reason why we want to make sure we've got the ground floor and the second floor layers, in our portfolio right now, is because that's what the market is giving us. But two, if you are an investor that didn't have these things in your portfolio in the past 5 to 6 years, this is an amazing time to insert them. And the second floor would be, being in, say, like a mezzanine debt position, a secondary loan, a home equity line of credit, a HELOC or something like that, a line of credit or a loan on a property, supplemental loan, some sort of secured cash position. For us here, we have our PIC yield fund that would meet that type of secondary debt position. But it gives you a little bit of cash flow potentially with low or minimal volatility. On the asset, you're still very much in a secured position ahead of the entire equity part of the capital stack. And they're very short-term notes. I'm talking about 12 to 36 months, something very semi-liquid. Okay, we're not tying up our capital into a partnership equity investment that could go, 5, 7, maybe even 10 years. Okay, so again, foundational floor, build your ground floor with the cash flow debt plays, build your second floor with, again, expanding on those low risk liquid income plays like debt funds, or pepper in some mezzanine debt positions, say like with promissory notes for that second floor. Okay, and that brings us to the third floor, the upper floors. Okay, our preferred equity positions, our common equity positions. This is where you're going to build that longer term wealth, but take on more risks. So these are going to be your cash flowing businesses like multifamily, self-storage, car wash, maybe even to other types of businesses. Now, again, if we find those in this market, great. We need to do our due diligence and make sure that we're not catching a falling knife either. Now, I want to make sure that we expand on the debt funds, okay, a little bit, and the promissory note funds, and make sure that everybody really can fully understands what I am talking about as far as a good secured investment in a debt fund, as well as a promissory note fund, okay? Because just because we say debt, not, as I illustrated earlier, not all debt is created equal, okay? Just because you see a debt fund doesn't mean that it's safe, okay? But first, let's understand what is a debt fund. And that is an investment vehicle that provides debt financing to a real estate related project, okay? It can be anything. It could be a single family home. It can be a high-rise apartment building, okay? Or just a high-rise office tower, okay? Now, these funds raise capital from investors in order to lend out or invest in one or more debt instruments. Okay. Now, like I said, not all debt funds are created equal. So when we are looking at our own personal capital stack, building that foundation, building that ground floor, okay, I'm talking about investing in those debt funds that are boring, lazy, okay, just super solid. They provide the cash flow, but no other excitement, okay? Okay, they take advantage of the market and the debt cycles. They put you in a true priority position in the capital stack with zero leverage, meaning you're not behind a bank line of credit, okay? And you're in a super stable asset class, okay? Debt funds should create a buffer, cash buffer in your portfolio with regular distributions. And I would also look for a debt fund that allows you to compound so you could actually mimic an equity-like growth return if you wanted to. Now, the debt fund in this, whatever debt funds we put in this ground floor layer, we need to make sure that there's liquidity there, okay? Say 3 month to, less than a year liquidity. Okay, that's what's there for, to be super flexible, super liquid. Okay, having that type of liquidity will keep us from withdrawing funds in other part or selling assets in other part of our portfolio, should there be some sort of volatility. Okay, it'll help you avoid a forced sale or short liquidation timelines. Now, a debt fund should also provide true diversification. Okay, meaning if you're going to go into a debt fund, we don't want it to invest in just one or two assets. We want it to invest in hundreds of assets at the same time. Okay, in this case, we want it making hundreds of loans to multiple borrowers, multiple markets in multiple deals. Okay, so we want it to do more than just say make a couple loans. Because if it just had a couple loans in the debt fund, that makes it even riskier and you should actually get a better return. Now, if you're here live, go ahead and or watching the video, go ahead and take a quick little screenshot. This is just like a base due diligence tool that I would help, that will help you underwrite a debt fund or, more importantly, help you know what to look for. So again, we're looking for, especially if we're building out this ground floor layer of our capital stack, okay, of our all-weather portfolio, we want to put in that particular layer things that are going to be in first lien position, okay? We want them to be truly in the first layer of that capital stack. We want them to be kind of boring investments, like single family residences. We don't want to be exposed to that volatility in different asset classes or the ground up development, okay? That's great if you want to add that to your portfolio, but just know that type of investment doesn't go on the ground floor. That will go in probably the second floor or in the upper layers of when you're building your investment house. Okay, we want to have true diversification, that 400 loans plus over multiple markets, multiple borrowers. We're looking for loans that are short in duration, say like 6 to 9 months. Why is that? Is so your capital continues working, but also that the fund is flexible to what's happening in the market. All right. Distribution, I love funds that distribute monthly. That's how we all kind of have built our lives, is around a monthly income coming in. But also, if you want to invest through an IRA, do they provide compounding? Default rate, the industry for debt funds says 1 to 3% is pretty standard. Okay, but why not shoot for zero? Right? Why not invest in a fund that is shooting to have zero default rates? Okay, I would look for the lowest default rate possible. Lockup periods. A lockup period is when you invest in a debt fund and you can't withdraw your money, say for 12 months or 36 months. Okay, those are long, lengthy lockup periods. Okay, again, remember, if we're going to put this in that ground floor layer, we want it to be flexible. Okay, it's not to say that we are going to withdraw it. We probably won't. We'll probably leave it intact, but we want to have that liquidity. So we want to look for zero lockup periods if possible. And then levered debt funds. There are debt funds out there that will do 20 to 50% leverage on their fund, meaning they take your money and they take it to the bank to get a larger line of credit. That way they can lend out. But are you in first position anymore? Probably not. Okay, you're now sitting behind a bank line of credit. If something were to happen to those loans in the fund, who gets paid first? Not you as the investor, the bank does. Okay, so I would look for funds that have zero leverage in their fund. Now, I put a little asterisk here because they're, a small line of credit, potentially to help smooth out the income coming in and out of the fund may be warranted, say like 5% or 10%, but anything above that, they're probably juicing the returns. All right. Now, if you're interested in learning more about our debt fund, we offer a 6 to 10% preferred return. And the fund has hundreds of loans, near zero default rate, zero deficiencies, zero leverage, short-term liquidity. Guys, check it out. You can email me at whitney@passiveinvesting.com. But most importantly here, I wanted to show you with a debt fund that you can actually get an equity-like return if you allowed it to compound. Okay, say you didn't need the cash flow, you wanted to allow it to compound and grow. Then I use, for illustration, our fund at $100,000 investment. If you allowed it to compound at 8% for 10 years, that's a 17.01% return. That is almost an equity-like return for very, very minimal risk. All right, so we talked about the foundation, touched on liquidity and reserves. We talked about what should be going into that ground floor, the lowest risk investment possible. Now let's build the house, that second layer. Okay, that's our secured cash position. All right, so this is a layer where we can take on a little bit more risk for a higher rate of return, but still stay, again, in that secured position with an asset with lower minimum volatility. And one of my favorite investments for this layer is in promissory notes now, or a promissory note fund. Now, I think a lot of other people would also say that distressed debt or secondary notes falls into this type of category. It does. But the reason why I like promissory note funds, especially, and I want to be very specific, promissory notes into deals that are performing. And that's the key thing. I want to be in a secured position in the capital stack. I want to be, prioritize repayment. I want to have clear terms. I want to have predictable cash flow, but I want to, if I can, with this layer, be in performing assets, not non-performing assets. Okay. Now there can be, I can actually earn the same type of return by going into a promissory note fund on a performing asset versus a note fund that does unperforming assets. Why should I take on that risk? Okay. So this is why one of the things that we introduced just recently, it's going to be open for just a short period of time, and that is our PIK Yield Fund. This is capital that's going to go to getting our performing assets across the finish line, and you can earn a 10 to 14% return based on your investment. Now, I want to show you how this looks like with a real live investor that I've worked with. If you copied this type of plan, again, I'm not saying copy this plan. You need to take this information and adapt it to yourself. How does this work in responding to the interest rate environment? Because that's how we started the conversation. Well, one, I think a lot of people are nervous when they get in an interest rate environment, okay, especially high interest rates. And when interest rates start to drop, that usually means the economy is not doing so well. We've got that first tier buffer, okay, that foundational cash that's been invested, your liquid reserves. They may be in high yield savings account, money market accounts, T-bills. Okay, maybe you have some in your cash flow life insurance that's earmarked for reserves. Okay, that is liquid cash that you can get to in like under a couple days. All right, then we've got that tier 2 cash. That's going to be our ground floor. Okay, our first position, our investments in first position, say debt, our income that's coming in, and that will give you a nice cash flow buffer. In the case of Wendy here, she was able to not only build out her $120,000 worth of reserves. She's a single woman only one income coming in. If her income faltered, she had enough reserves in the sideline, but she also built out that second tier in order to buffer the first tier a little bit. And again, that just brought in some nice stable cash flow. It would actually help her not pull down her liquid reserves, as well as not sell some of her equity in growth assets. Okay, so that cash flow provided then, or that ground floor cash flow provided some nice liquidity there. And then we get in the tier 3 growth. Now, in the case of Wendy, we didn't really have anything for her to take a look at, okay? So meaning she didn't have any multifamily or express car washes to go into at this point in part of the market cycle. So we actually took that cash and we put it in to some liquid assets, like our PIC real estate debt fund, as well as some semi-liquid assets like the PIC yield fund. And we're just letting it sit there, earning equity-like returns while we're waiting for the market to change course and those equity investments to come back online. All right, so just some quick visuals. I know we've gone a long time today. I think what keeps a lot of investors from building out this kind of equity layer, or excuse me, cash flow layer of their portfolios, like they're nervous. They're like, why would I do that when I could just wait and hope and pray that the Fed starts lowering interest rates, which remember, it doesn't matter if they start lowering interest rates. We don't need them to lower interest rates. We need the 10-year Treasury to adjust, okay? But long story short, they're fearful. They're fearful of losing out on a return. And I want to debunk that myth because in the case of Wendy, for her, we took that $300,000, and if she put that all in the PIC real estate debt fund and just let it sit there and compounded 8%, in 15 years, she'd have close to $1 million. Or if she let it go 20 years, she'd have almost $1.4 million. Okay, compounding. That's assuming that Wendy never found another investment to go into. It's assuming that she never deployed anything into a secondary note position. Okay, so I wanted to debunk that. You can make some nice returns right now in this high interest rate environment while you're still putting yourself in a very flexible position and to be able to take advantage in the next part of the market cycle. So our take-home message here today is make sure to structure your portfolio to take advantage of the environment that you're in. Get clear, get liquid, ID which layer of the all-wealth passive portfolio you're lacking. Which floor of your house do you need to build? Okay, and then use what the market is giving you right now. Use the debt, use the notes, and if equity, in a very strategic layered way. Now, guys, if you're here live, don't go anywhere. We're going to start the Ask Me Anything part of our show. But just want to wrap up one quick point here. If you want to join our passive investing club, you can do that here at passiveinvestingwithwhitney.com. All right, let's jump over. I'm trying to pull up the Q&A box. Oh, somebody asked, I guess for our PIC real estate debt fund, I'm going to assume that, what percent are you charging to borrowers? So in the PIC real estate debt fund, how it works is that we're raising money. Let me go back here. We are raising funds in an investment in the PIC real estate debt fund. It's being deployed by Rehab Wallet, our lending arm, into fix and flip real estate. Now, the borrowers here are for fix and flip real estate are fairly price insensitive, meaning what is most advantage to them is that they have cash to close on their asset that they're buying. So typically it's a 3-bedroom, 2-bath, single-family ranch property in the Carolinas, either North or South Carolina. And that's where we do a lot of our lending. And so they need to close that property like cash. So they need it fast, like in 5 days, 10 days. So that, it's kind of like you look at the value triangle. Okay, you can either have speed, something good, fast, or cheap. Okay, pick two. So typically somebody wants a really good lender and they want it fast. Okay, they're cheap is not necessarily what they're looking for. It's how I scaled my over 40 units of single family properties, was using hard money lending. So these type of borrowers, they're used to paying 12 to 14% for a loan and maybe 1 to 2% in points in order to close that loan. Okay, so that's been pretty standard for as long as I've been in the, doing fix and flips. Okay, so I really haven't seen those rates move a whole lot. Maybe tick down to 11%, up to 15%. Okay, so it's really that spread, okay, that we are capitalizing on. Okay, the spread between what they're paying in an interest rate and then what we're paying back to the investor. Okay, and I want to draw your attention here. Our investors receive their preferred return of 6 to 10%, depending on what tier they invest in, before we pay any expenses or realize any profit to their fund. Okay, so that's just how powerful this type of lending is. How do you manage to have a very low default rate? I love this question. It goes back to how we work with our borrowers. One, okay, which type of borrower we source. During this interest rate environment, we could have bumped up our interest rates a lot more, but we decided to keep them in that 12 to 14% range for the fix and flip fund, and so we could attract repeat borrowers. And so these are people that we've worked with. We know them, they know us. So number one, working with a great borrower. Okay, that's one key thing. Number two, we do a lot of due diligence on the asset that they're closing on. So we want to make sure that if we had to foreclose, it is something that we would take on and complete the project. Now, that's not the business we're in. We don't want the property back. We want them to fulfill their construction obligation and reposition the property. But number two, we want to make sure that it is something that if we wanted to lend on, that we would be okay having in our portfolio and taking back and completing the project. Okay, but number three is really the tracking and the customer service here. So oftentimes, if we run into an issue with a borrower, we sometimes know the borrower is in trouble before they even know they're in trouble. And here's a good example. So we have a borrower, maybe they closed on the property, and then we noticed that they were approaching 30 days and they haven't put in a draw request to be reimbursed for any of the construction that they've done on their property. So that tells us they haven't gotten off on the right foot. We are going to be in immediate contact with that borrower to really, truly understand what's going on at the property. Okay, so it's just little nuances like that that help us stay in tune with our borrower, and we can set that all up through systems. So while it is very kind of high touch with our borrowers, it's not something that has to take a huge amount of time. We have an amazing team and some very strong systems in that side of the business. Let's see. Oh, another question came in. How long is your lending arm? So the PIC Real Estate Debt Fund, we actually launched that in June of 2020. So right after the COVID shutdown. Now, we had actually been putting together the business. That would just happen to be when we were going to launch it, and we decided to continue to launch it in the middle of the COVID shutdowns. Now, so that side of that business arm has been in existence almost 5 years. We've lent over $400 million through that lending arm. Today, we hold about 400 loans at any one point in time that average about $150,000 to $160,000. Now, I think what's even more important is to understand the track record and success of the managing partner, Kelly Garrett, as well as our managing director, Angela Dunn. The two of them, have multiple decades of experience in the lending industry, as well as fix and flipping. So they've actually done the business plan that they're lending on. They each have multiple fix and flips going on themselves at the same time. Now the fund doesn't lend to them. Okay, there's a separation here. They can't use the fund as their own for their own fix and flips, but they both worked and borrowed and lent through 2028, 2029, or excuse me, sorry, 2008, 2009, 2010. So, and Kelly really saw it all. She saw all the mistakes that, a lot of the lenders had made in that run up. And she said, like, if she were ever to start her own lending business, she knew exactly what not to do, how not to structure it. And so it's really, bringing in that track record, background, and experience. That's another reason why it allows our business to run as smoothly as it does today. What other questions do you guys have? Well, I have a question for you. Go to the chat. Was this useful information? One, to understand exactly what's happening in today's market. And even despite all the things that are happening in today's market, why interest rates still remain high. And it's because the market, or the mortgage rates that we need to see, or we want to see come down, are actually tied to the 10-year treasury, not to the federal funds rate. So that's actually the metric we need to see to move. But also, the other thing that we covered that I hope you found useful is like, okay, now, if we're in this volatile environment where things are going to stay higher for longer, how do I set up my portfolio and actually take advantage of that? So awesome. Somebody said very useful, fantastic. Now, as always, if you guys have a topic you would like to see covered on the masterclass, please reach out to me at whitney@passiveinvesting.com. I would love to hear your ideas. I read every single one. And if you're looking to jump on a one-on-one call with me, you can go to passiveinvestingwithwhitney.com. All right, guys. Thank you so much for taking the time out of your day, not only to spend it here with me, but to invest in yourself. Take care.